So open with me November 2018, question 2. B Limited and H Limited are private liability limited companies operating in the service sector. They have been reporting successful trading losses for several years, principally due to severe competition from the which has put down pressure on their revenues. The director of the two entities, who are also the main shareholders, have unanimously agreed to wind up the company respective business and amalgamate them into our new company to be named S Limited with effect from 1st of October 2018. Now, up to that point, is it an internal reconstruction or external reconstruction? Yeah, this one is an external reconstruction. Since there is a formation of a new company, we have to liquidate the current company for us to form the new companies. And in this case, we had two companies. We have B Limited and we have H Limited. We amalgamate the two, we form one new entity to be named S. The statement of financial position of the two companies as at 30th of September 2018 are set out below. So you're given the statement of financial position. Let's go to the additional information. Now note that we say that whenever you have a question on external reconstruction, number one is to determine the purchase consideration. How much will S, that's the new company, will pay the shareholders in B Limited and H Limited. Number one, the authorized share capital of the new company was 120 million, comprising 12 million ordinary shares of shillings 10 per value. Number two, preference dividend in B Limited 3 years in arrears. So to preference shareholders, we say that when determining the purchase consideration, number one, you compute the amount payable to ordinary shareholders, amount payable to preference shareholders, amount payable to debenture shareholders, and then you factor in what? The reconstruction cost. I mean the liquidation cost. So I told that the preference dividend in B Limited were 3 years in arrears, while in H Limited, preference dividend had not been paid for 2 years, including the current year to 30th of September 2018. So let's go to the preference share capital. So for B Limited, you'll take 7.5% of the preference share capital, which is 10. They were in arrears for how many years? 3 years. Then 7.5% for H Limited, we have is 24. In H Limited, they were in arrears for how many years? 2 years. So give me the dividend in arrears. Yeah, because I do that. For B, there were 3 years in arrears. For H, there were 2 years in arrears. So how much was the dividend in arrears? Hey, let's hurry up. 2250. That's 600. So those are the dividends in arrears. Then you are told that only 20% of the arrears of the preference dividend were settled by issue of ordinary shares of shillings 10 each in S. So they were settled through the issue of ordinary shares, and only 20%. So you multiply by 20%, you multiply by 20%. So the preference shareholder in B, they received how much? 450. What about H? Good. They received ordinary shares of 720. Number 3, S Limited issued 3.4 million ordinary shares. So there was issue of ordinary shares, and they issued 3.4 million ordinary shares, each credited at 5. So it's 3.4 million shares, each at 5. How much is that? That is 17,000. So I thought that S Limited issued 3.4 million ordinary shares, shillings 10 each, credited at 5. You see the par value is 10, but they only credited at 5. There is a balance of how much per share? 5. In the favor of the preference shareholders in both companies, the ordinary share were allotted on the basis of the preference share held in the old companies. The preference share committed to immediately pay the balance on the shares issued. So they paid the balance of 5 shillings. So how was this amount allotted? We are told that it was allotted based on the share, the preference share capital. Now let's go back there. Under the equity, the preference share capital, we had 10. For which we had an amount of 24, and the total is 34. Can you allocate this? So that means to be, you'll take 10 over 34 times 17. 5,000. So that means for H would be an amount of, so not 12,000, it's 17, you minus 5. Will you get 12,000? Or you just take 24 over 34, then you multiply by 17. Good. Number 4, the bond holders. So now we are through with the preference shareholders. So now let's go to bond holders or the debt holders. How are they paid? The bond holders in the both companies were settled immediately by the new company issuing ordinary shares of shillings 10 each to satisfy the nominal value of the bond. So the bond holder, they were given ordinary share to satisfy the nominal value. Now B, how much was the bond? So that means they received shares worth how much? 20. And then H received shares worth how much? 15,000. Good. Number 5, the new company also issued 4.6 million ordinary shares of shillings 10 each, created at 2.5 in the favor of ordinary shareholders of the old companies. So now we go to ordinary shareholders, and they were given ordinary shares. We are told that the new company also issued 4.6 million shares of shillings 10 each created at 2.5. But remember the par value was how much? 10. So there's a balance of 7 points. Yeah, we expect them to pay that in cash upon the receipt of shares. So that means 4.6 each at 2.5, 11.5. So the new company also issued 4.6 million ordinary shares of shillings 10 each, created at 2.5 each in favor of the ordinary shareholders in the old companies. The ordinary shares were allotted on the basis of the ordinary share held in the old company. So how did we allot this? So let's go to the ordinary share capital. Here we have 30,000. We have 16, and the total is 40. Now let's use this ratio. 30 divided by 46. Then you multiply by 11,500. That's what we are allocating. 7,500. So 11,500 minus 7,500 to get 4,000. Number 6, the current liability of the old company were transferred to the new company at their book values. Number 7, copyright of B expired upon amalgamation of the old companies and were therefore to be written off. Number 8, the tangible assets were taken over by S Limited at their fair values as follows. Number 9, liquidation expenses. You see that also liquidation expenses will be settled by the new company. That's S Limited. So therefore it will be factored as part of the purchase consideration. So liquidation expenses. We are told that liquidation expenses of B Limited and H Limited amounted to 8 million and 5 million respectively, were paid by S Limited and treated as a preliminary expenses. So 8 million And here we have 5 million. So how much was the purchase consideration? Sorry? 4950. That's 720. So therefore, how much was the total purchase consideration? So it's 4950. That's to be paid to B Limited, and H will pay that 6720. You get 70? 670. Eh? So that means S will pay 77,670 to take over the business of B and H Limited. Number 10, assume that all the above transactions were completed by the close of the business on 30th of September 2018. Required the following ledger account in a columnar form to close off the books of B Limited and H Limited. Number 1 is the realization account. Number 2 is the preference shareholder sundry members account. And then number 3, we have the ordinary shareholder sundry member account. So number 1, to prepare the realization account. You say that, how do you prepare realization account? So that you debit all the assets at the net book value. So we have 2 companies. We have B Limited. We have H Limited. B Limited, H Limited. Then number 2, you have to prepare preference shareholder sundry member account. We are told that we prepare in a columnar form. So we have B and H, B and H. Then number 3, we have to prepare ordinary shareholders sundry member account. So now let's start with the preference shareholders member account. We start by recognizing the balance brought down. For B, we had 10. For H, we had an amount of 24. Then they also had the dividend in arrears, so that will increase their claim. So the dividends in arrears. So for B Limited, there were 3 years in arrears. For H, there were 3 years in arrears. So this was 2250, and this was an amount of that 600. So that means at the date of conversion, they had a claim of how much? This is 27,600. This one is 12,250. Now, how was that amount settled? So we have 12,250, 27,600. It was settled by S through the issue of ordinary shares. That's part of purchase consideration. To preference shareholders, number 1, they were given the ordinary shares. That's part of the purchase consideration. So they were given ordinary shares. Now, to cater for the dividend in arrears, only 20%, that's for 50, and H got 720. Then to cater for the balance brought down, they were issued ordinary share created at 5, 17,000. To B, 5,000, to H, 12,000. Also, they were given additional ordinary shares, 5,000, 12,000. Now the balance is what they expect to realize. So what do we take to the realization account? So remember, you're closing off the books. So there should be no balance carried down. So the balance carried down. Now the balancing figure, you take it, you proceed to the realization account. Sorry? Like that. $14? 880. We do the same for the ordinary shareholders. So we start by recognizing the balance brought down. The ordinary share capital for B Limited, we had 30. For H, we had an amount of 16. But this is not ordinary share capital account. This is the ordinary shareholders members account. So under the equity, what else related to the ordinary shareholders? You also have share premium. That's their wealth, and the share premium was an amount of 1,600. Then we had an amount of 14. Then retained earnings, those are their wealth. But in this case was losses. So accumulated losses you credit. Accumulated losses. We had an amount of 23,400. And then we had 34,300. Also, we see that in case there is goodwill, goodwill is the wealth of the shareholders. And we are told that, can we go back to note number 7? Number 7. Copyright in B Limited expired upon amalgamation of the bond of the old companies and were therefore to be written off. Yeah, so it's an intangible asset, that's their wealth. So if the asset reduces, also the equity base will reduce. So you have the copyright written off. How much was it? So it was an amount of 84. Then the balance was paid through the issue of ordinary shares. Here it is. To ordinary shareholders, they were issued with 4.6 million traded at 2.2, 11,500. So B got 7.5. And here we got an amount of 4,000. So let's close that. What do we take to the realization account? This side is more, right? So give me the total. How much is this? That's 9? 300. So that means the realization will be on this side. 77. Yes? 2,900. So now let's answer part 1. Now part 1, we have to prepare the realization account. You see that on the realization account, you debit all assets at net book value. So assets at net book value. Now let's go to the balance sheet. Number 1, we had the PPE, an amount of 16,500. Here we had 12,000. Intangible assets, the corporate has been written off. We also had the current assets. For B, we had 52,500. Here we had an amount of 30,000. Also, we say that also you factor in the preliminary expenses, such as liquidation expenses. And liquidation expenses being 8,500. Also, there was dividends in arrears. And the dividend in arrears for B were 3 years in arrears, an amount was 2250. And then for H was an amount of 36. Then what do you credit? Yes, the current liabilities. Now let's go to the current liabilities. The current liabilities, we have trade payables. We also have the bank OD. So trade payable, we had 37,200. Here we had an amount of 18,400. We had 2,000. Then you had 15. Now, if you take the assets, see, we have debited the assets. If you take the assets minus liability, you get the net asset. Then you compare the net asset against how much were they paid. And what they were paid is what you call the purchase. Good. The purchase consideration. Now, to acquire the assets of B and H, this is what they were paid. B was paid an amount of 40,950. H was paid an amount of 36,720. And then we cross off the accounts. Now, from the preference share account, there was a realization account here. You debit, you credit. So preference share account, B Limited was an amount of 68. Then you have an amount of 14,880. From the ordinary shareholders members account, the realization is on the credit side. So you credit, you debit. Ordinary share capital account. So we have an amount of 77. We have an amount of 20,900. So what do we have? Which one? This one is 80, 950. Sorry? 71,500. What about this side? Good. 8950, 71,500. Remember, we are closing off the books. So therefore it should balance. That's how we get to your 12 marks. Let's go to number B. Sorry? 86,950. Both. 86. Good. Then number B of the question. Journal entries in the books of S Limited to record the transfer of asset and liability. Ignore the narration. Now, what are what are some of the journal entries to record in the books of the new account? We see that number one, you record the assets taken over, liabilities taken over. Number three was what? Goodwill. Then number four, you record the purchase consideration. So you need to come up with the journal entry. It's all about debiting and crediting. So number B is the journal entries. So what do we debit? What do we credit? Say number one, we factor in assets taken over. You say that for the assets taken over, you debit the asset, you credit what? Good. Not purchase consideration, the business purchase account. Good. Now let's go to note number 8. And this one will be recorded by the new company. That's S. So therefore, you'll not prepare in a parameter. You not prepare for the two companies. So you combine the two by the new companies. And you're told that number 8, the tangible assets were taken over by S at the fair values as follows. We had PPE. So for B, at valuation of 12,500, for H, 95. How much is the total? That's 20. 22, eh? Debit 22. Also, they took over the current assets. Current asset, we have 58,000. We had an amount of that 8,600. So how much is the total? 96. Then you credit the business purchase account. So can you add the 2? 118. Also, there is another asset we see that you need to capitalize. That's the liquidation expenses. So liquidation, yeah, we say that liquidation expenses should be treated as a preliminary expenses, and therefore they should be capitalized. We had 8 plus 5. We had an amount of, yeah, we debit to credit what? Cash account, amount of. Then number 1 was assets taken over. Number 2, you record the liabilities. taken over. For the liabilities taken over, you debit the business purchase account. You credit the liabilities. Number 6. The current liabilities of the old company were transferred to the new company at book value. And you only had 2 current liabilities. We had trade payables, and we had the bank overdraft. So trade payables, you have 37,200. You had 18,400. Bank overdraft be 35. So much is the total? 55? Now, can you add 35? That's for the bank overdraft. 2015. 59? 100. Debit, credit. Then number 3, we determine the goodwill. And how do we get the goodwill? So goodwill is the difference between the purchase consideration. And how much was the purchase consideration? The purchase consideration was 77,670. You raise the net assets acquired. And the net asset acquired is asset minus liability. So you take the assets. Here they are assets. The assets taken over, the total is 118,600. Then you capitalize the preliminary expenses, an amount of 13. So how much was the total assets? 130. 131. Then you raise liabilities taken over, and here the liabilities taken over 59,100. So assets minus liability, you get the net asset. So how much is the net asset? Sorry, 72,500. So the net asset acquired was 72,500, but they were paid 77,670. So the difference is the goodwill. 51,70. Good. So you say that for the goodwill, you debit the assets, of which goodwill it's an asset itself, an amount of 51,70. Then you credit the business purchase account. An amount of 51,70. And lastly is the purchase consideration. And how do we record the purchase consideration? What do we debit? So that you debit the business purchase account, which was an amount of 77,670. Then you credit the vendor's account, 77,670. So you can take a screenshot. So now let's answer part C of the question. The opening statement of financial position of S Limited. So let's prepare the statement of financial position. So allow me to eliminate this. So it's S Limited. Prepare statement of financial position. We'll start with the assets. Non-current assets. For the non-current asset to take the assets taken over. Number 8, the tangible assets were taken over by S at the fair values as follows. So we had PP. How much was the total? Add the two. It was 20? 22. Then there was goodwill arising. An amount of? 51. Then we have the current assets. Still at number 8. Can you add the total? 58 plus 38, that was 90? 96, 600. Then there is cash. Did we have cash? Yes, we had cash. We had cash. Now, remember, let's be here. Remember, we had some shares which they were partially paid. What were you told? The shareholders were? Can you go to number 3, the last point? The ordinary share allotted. So the preference shareholder committed to immediately pay the balance on the share issue. That was for preference shareholders. Let's go to number 5, the last sentence. The ordinary shareholders were to pay the balance on the shares immediately. So here it says, we issued 3.4 each at 5. So how much was the balance? Good. Ordinary share, it's 3.4. It was created at 5. So they were to pay the balance of 5. So that means upon the receipt of the shares, they were to pay the balance of how much? 17. Then to ordinary shareholders, we issued 4.6 each at 2.5. So there was a balance of how much? Good. Ordinary shares, 4.6. You multiply by 7 point. How much is that? 34. Then you raise the liquidation expenses. And that's why in the journal entries, we have that for preliminary expenses, you debit the preliminary expenses, you capitalize them, then you credit the cash account. We had 8 plus 5, and the total was? That's for, is it 38,500? Oops. Then equity and liabilities. For equity and liabilities, we have ordinary share capital. So much is the ordinary share capital? Here they are. The preference shareholders, they were paid through the issue of ordinary. See it, ordinary shares. 450 plus. In short, actually, the company only issued ordinary share. All these total purchase consideration of 77,670, it was shares apart from tuko pamoja. So, so you can take 77,670. This was issue of share, ordinary share, ordinary share, ordinary share. Then you minus 13. What do you get? Good. Plus, remember some of the share issued here, they were partially paid. But upon a receipt of the share, they paid the balance. How much was the balance? This, not that it. So it's 17 plus 34. How much is that? You're getting an amount of 116, 170. Okay, let me show you here again. Ordinary share. Number one, we paid the preference shares for 50 plus 720. How much is the total? 11. Also to preference shareholders again, we give them 3.4 each at. So it's 3.4 each at 10 because upon the receipt of share, they paid the balance. So the shares now will be fully paid, an amount of 30. Then to bondholders, we give them ordinary shares. So to bondholders, we give them shares at par 20 and 15. So 20 plus 15, you get an amount of 35. Also to the ordinary shareholders, we issued 4.6 million shares. Created at 2 point. But remember, upon the receipt of share, they paid the balance. Yeah, to ordinary shareholder, 4.6 each at 10. Good. So it will be 46. How much is the total? Let's still give you 116, 170. Good. Then we go to the liabilities. Liability is only the current liabilities. The bondholder, we paid them. The only thing that we transferred was the current liabilities. Yeah, you are told the note number 6. The current liability of the old company were transferred to the new company at book value, of which we had trade payables, and we had what? Yeah, the bank overdraft. So trade payable, how much is the total? That 7,200 plus 18 was? Sorry? 55? Then we had bank OD, 2,000 plus 15, you get? So now let's try to balance that. Can someone add the total equity? This one is 175. What about the assets? One. So we never, sorry, 171. We never captured the preliminary expenses, right? Yeah, we had the preliminary expense. We say that we should capitalize them. 8 plus 5, 13. So what 13? 175 to 70. Good. You can take a screenshot. Want to ask something? May 2021. May 2021, question 2. Swara Limited has been suffering great financial stress. The director of Swara Limited decided that the company should be restructured, reconstructed. The following was a statement of financial position of Swara Limited as at that 1st of March 2021. So you are given the statement of financial position. Additional information. On 1st April 2021, a new company, Twiga Limited, internal, external? External, good. Now, Swara now will have to be liquidated so that they can form a new company known as Twiga Limited. Yeah, on 1st of April 2021, a new company, Twiga Limited, was formed to take over the business of Swara Limited. Twiga Limited was formed with an authorized share capital comprising 600 million ordinary share of shillings 10 each and 40 million 6% preference share of shillings 100 each. Number 2, preference dividend in Swara Limited were 2 years in a year. Good. So now we start with 2 preference shareholders. They had their dividends in arrears. Dividend in arrears. So we are told that the preference dividend were 2 years in arrears. So how much was the rate of the dividend? 8% of 3.6. Then you multiply by 2. So how much was the outstanding amount? Sorry? 576, like that. Good. How was the amount paid? Can we go to note number 4? Let's go to note number 4. The preference shareholders in Swara Limited would forego half of the preference dividend in arrears and would receive fully paid preference shares in Twiga Limited for the balance of arrears of the preference dividend. So only half. So the amount was 576. They were to forego half. The other half they were to be paid through what? Good. They were given preference shares, fully paid for the half. So that will be 288. So they received fully paid preference share. Number 3, 3 ordinary shares of shillings 10 each, credited at 5 in Twiga Limited, would be issued for each preference share in Swara Limited. So they were issued with ordinary shares. And what was the term? So we are told that 3 ordinary shares of shillings 10 each, credited at 5 in Twiga Limited, would be issued for each preference share. For one preference share, they got how many new shares? 3. So how many preference shares are outstanding? How many shares we had? How many shares we had? Can you take 3.6 to divide by pi, which is 50? What do you get? Good. 72 or 7200? Good. 72. Good. So for everyone, you get 3. What about 72? Get an amount of 216. Each created at 5. How much was that? So each was created at, you get an amount of 10, 80. So there is a balance. Remember the power was how much? 10. But they only created at 5. So there is a balance of 5 per share. Then you are told that, in addition, one fully paid preference share in Twiga Limited would be issued for every 4 preference shares. So in addition of being granted ordinary share, they were given additional preference shares. And what was the term? We are told that, in addition, one fully paid preference share in Twiga Limited would be issued for every 4 preference share. What does it mean? For every, you get 1 fully paid preference share. What about 72? Sorry? 18 each at? They were fully paid. Eh? So those are the number of new preference shares to be issued. But you want to convert them into monetary term. How much was the preference share? Soma number 1. Was an amount of? Good. Yeah, so you're told that, in addition, one fully paid preference share in Twiga Limited would be issued for every 4 preference shares in Swara Limited. The preference shareholder would, however, pay the balance to make the ordinary share fully paid. Yeah, of these they had paid 5. The balance of 5 they'll have to pay in cash. We have done number 4. Let's go to number 5. One ordinary share of Shillings 10 each created at 5 in Twiga Limited would be issued for every 2 ordinary shares in Swara Limited. So we are done with the preference shareholders. Now we go to ordinary shareholders. And the ordinary shareholders, they were given new shares by Twiga. You're told that one ordinary share of Shillings 10 each created at 5 in Twiga Limited would be issued for every 2. So for every 2 you get. So how many ordinary shares did we have? We had? So it will be an amount of created at, so you get 750. Good. And then you are told that the ordinary shareholders would, however, pay the balance to make their share fully paid. Number 6, the debenture holders. So now we go to debenture holders. The debenture holders would receive half of their dues, excluding accrued interest, in 6% debenture of Twiga Limited, and the balance in fully paid ordinary shares of Twiga. Have you understood? No, I'm not explaining. Can you read that again? How much was the value of the debenture? How much was the debentures? 24, 24, you multiply by 50%, you multiply by 50%, you get 12, you get? Now, what do you need me to explain there? Surely. I think the question is straightforward. Actually, hakuna kitu imefichwa hapo, it's straightforward. Sasa someni mara 4, muone kama mtaelewa basi. Do you have anything complicated there? No, straightforward. Let's read the last sentence. I'm not explaining that one. Interest accrued on debentures would be paid in cash by Twiga Limited after taking over Swara Limited. Number 7. So now we are through with the amount payable to preference shareholders, ordinary shareholder, and debenture holder. So now we are remaining with what? The liquidation expenses. Good. Number 7 to that, trade payable would be taken over by the new company and immediately settled by issue of fully paid ordinary share of equal value. Number 8, the assets were transferred to the new company at the following values. So we're given that. Number 9, Trigger Limited paid that million to Swara to pay for dissolution expenses. So you add that. Give me the purchase consideration. $63. So that was the purchase consideration. Number 10, Trigger Limited issued for cash and par value all the remaining ordinary shares and preference shares not issued as part of the settlement of the purchase consideration on acquisition of Swara Limited. Assume that all the above transactions are completed on 1st of April 2021. Required the following accounts in the books of Swara Limited. One is the realization account, Trigger Limited account, ordinary shareholder sundry member account, preference shareholder sundry member account. So number 1 is the realization account. And then number 2 is Trigger Limited account. Which account is that? Good. The purchasing company account. Or the vendor's account. Then ordinary shareholders. Sundry members account. And also you have to prepare the preference shareholder sundry members account. And so now let's start with purchasing company account. We see that for the purchasing company account, the vendor's account, it only records one item, the purchase consideration. And the purchase consideration was an amount of 63.40. Now, how was this amount paid? Number 1 was paid through the issue of preference shares, also issued ordinary shares, also issued debentures, and the balance was paid in cash. Preference share. So here we issued preference share worth 2888, preference share worth 18. So how much is the total? That is 2080. We also issued ordinary share. So for the ordinary shares, we have that, also issued ordinary share, also issued ordinary share. So how much is the total? 30? 30. Also issued debenture. Debentures issued was an amount of 1,200. Then the cash will to cater for the liquidation expenses, an amount of 30. So add the total. $63.48. Good. And then ordinary shareholder sundry member account. So we start by recognizing the opening balance. Balance brought down, we had an amount of so it's 3, eh? An amount of 3. Anything that belongs to the shareholders? What do you have? Just look at the equity. What do you have that belongs to the shareholders? Good. Profit and loss. That's what you call accumulated losses. It's a negative, eh? Yes. You see that accumulated losses, you credit an amount of 25? 25.20. Then can you check whether there is any goodwill? So that whenever you're facing financial concerns, you must write off the goodwill. Eh? Yes. Even if you're not told, you write off the goodwill. So goodwill written off. How much was the value of the goodwill? 300 yeah, it was an amount of 390. Then of the balance, how are they paid? To ordinary shareholders, Trigger issued ordinary share worth 750. So Trigger Limited gave them ordinary shares worth 750. So this side is more. So how much they expect to realize? The balancing figure goes to the realization account. Sorry? 660. So the total will be 36, 60, 36, 60. Preference shareholder sundry member account, we start by recognizing the balance brought down. How much was the balance brought down? 36. Then we are told that the preference dividend were 2 years in arrears. How much was the amount outstanding? How much was the amount outstanding? Good. The dividend in arrears was an amount of? Good. 570. So that means at the close of the business, they had a claim of 170. How was that amount settled? Number one, to cater for the dividend, they were given preference share for only half of them. They were given an amount of 288. So Trigger gave them preference shares worth 288. Then for the balance brought down, they were given ordinary share. Also, they were given additional preference share. So they were given ordinary shares worth an amount of 1080. Also, they were given preference share of how much? 1800. Yeah, preference share. So the balance is what they expect to realize. So you cross it to the realization account. Sorry? 1,000. Yes? 1,008. Unasema nini? Good. Not 1,008. 1008. Good. Now let's prepare the realization account. See that on a realization account, you debit all assets at? Good. Assets at their net book value. Now let's go to the balance sheet. We have landed buildings, an amount of 21, 34.2. Also, we have planted machinery, an amount of 1591.2. Then we have furnitures and fixtures, an amount of 594.6. Also, we had investments, an amount of 345 point, like that. Then goodwill was written off. Good. Also, we had what? We also had patents, an amount of 240. Also, we have preliminary. Yeah, preliminary expenses, an amount of 100.8. Let's go to the current assets. We said all assets, not non-current assets. We also had inventories. Inventories was an amount of 975. Then we also have trade receivables, an amount of 858. Then we also have cash at bank, an amount of 271 point. Then we see that to capitalize the preliminary expenses, we had the liquidation expenses. Liquidation expenses, an amount of 30. Also, we had dividends in arrears, an amount of 570. Then you credit the current liabilities. Let's go to the current liabilities. We want to determine the net asset at the date of when they were taken over. The current liability, we have trade. Yeah, we had the trade payables, an amount of 876. Then we had accrued debenture interest. An amount of 144. So if you take the assets minus liability, you get the net asset. Then you compare the net asset again is what? What they were paid. That's the purchase consideration. How much was the purchase consideration? Then we cross off this account. Ordinary shareholders, there is realization. You credit, you debit here. So ordinary share capital account, an amount of 660. Then preference shareholder sundry member account, the realization on the debit. So here you do what? You credit. Preference shareholders account, an amount of 100. Are you getting? Which side? Yes, 80. 76. Good. So that's number A. Let's go to number B. Statement of financial position as at 1st of April 2018 after completion of the reconstruction. So that is Twiga Limited. Prepare the statement of financial position as at 1st of April 2021. Let our shillings be in millions. So I start with the assets. Note number 8. The assets were transferred to the new company at the following values. So there is land and buildings, 2880. Then we have planted machinery, the value of 1770. Then we have furnitures and fixtures, an amount of 510. Also, we have the investments, an amount of 197.4. Then you'll factor in the goodwill, and the goodwill is the difference between the purchase consideration and the net asset acquired. Let's go to the current assets. Under the current assets, they took over the inventories. They also took over the trade receivables. Also, they took over cash at bank. And they told that the inventory were taken at book value less than %. Inventory was 975. You multiply by 90%. You get it? Trade receivable was an amount of 858. then was taken at book value less 5%. So multiply by 90, 95, 818.1. 818.818. Then cash at bank was taken at book value, an amount of 271.2. So we'll have to adjust the cash. Yes. We go to equity and liabilities. To the equity and liabilities, we have ordinary share capital. How much is ordinary share capital? Yes, we have 600 each at 10, so it will be 6,000. Also, there is preference share capital. I mean, number one, eh? Yeah. What do you have? 40, you multiply by 100, you get. So kindly ignore this right together. Let's go to the non-current liabilities. Yes, just ignore that. I'll come to explain later. Non-current liability, there is 4% debentures. How much is it? It's not in the 12 balance. Remember, we paid the debenture holder. Here they are. We paid them all together. But upon the payment, the new company issued additional debentures. Here you see the purchase consideration was 63.48, of which we issued preference shares, we issued ordinary shares, also we issued debenture with how much? Yes. Half of this amount, 24, they were given a debenture by the new company. Then the balance, they were issued with the new ordinary shares. So in the new company, we have that 12. Let's go to the current liabilities. To the current liabilities, the current liabilities were taken over. Let's go back to the current liability. What do we have the current liability? Trade? We have trade payables. How much was it? 870. But you are told that, let's go to note number 7. Trade payable would be taken over by the new company and immediately settled by the issue of fully paid ordinary. So we don't have trade payables, right? What else do we have? Just taking the trouble. What else do we have in current liability? Interest, right? Yes, and that one we are told that. Can we go back to note number 6? The debenture holders would receive half of their due, excluding accrued interest in 6% debenture of Trigger Limited, and the balance in fully paid ordinary share of Trigger Limited. Interest accrued on debenture would be paid in cash by Trigger after being taken over. So there is no current liability. The Trigger took over and paid immediately. In an example up to that part. So actually how to get that. So let's start with cash at bank. I prepare the cash account. How much was the balance brought down? The cash balance brought down. How much was the opening balance? It was taken over at book value 271 point. Let's be here. Here we had some shares which were created by how much? So they were to pay the balance immediately on receipt of shares. So ordinary shares. So 216 multiplied by 5. How much do we realize? Then also issued additional ordinary share, created them at 5. So there is a balance of 5. So it's 150 times 5. How much is that? 750. Then we paid for liquidation expenses. Liquidation expenses, an amount of that. We are told that the trade payable are taken by Trigger. What happened after that? Trade payables. It was an amount of 876 was paid in cash. Also, we had another current liability, debenture interest, which was taken over by Trigger, and Trigger was to pay in. Si tumesoma na nini saizi? Yes. Na tusome tena interest on debentures, an amount of 144. Then we had new shares. We also had new preference shares. Yes, simwambie mwachie hapa mkasema nimuonyeshe, wacha nimuonyeshe. Let's go to number 10. Trigger Limited issued for cash at par all the remaining ordinary shares and preference share not issued at part of the settlement of the purchase consideration on acquisition of Swara. Let me open for you ordinary share capital. Let me try to explain. Let's go to note number 1. As on April 2011, the new company was formed to take over the business of Swara Limited. Trigger Limited was formed with an authorized share capital comprising 600 million ordinary share of how much? Yeah, 600 each at 10. How much is that? 6,000. Now, can we go back to note number 10? Trigger Limited issued for cash and at par all the remaining ordinary shares. Tuangalie hapa. Erase what has already been issued. On acquisition, we issued ordinary share of how much? 30. As part of the purchase consideration, ndio hiyo tuweka ngapi? 30. But of this 30, some shares were not fully paid, but they were issued. Here they are. So those are ordinary shares. So cash, you add 1080 plus 750. Nakuja ngapi? 18. Itakuwa imebakia ngapi? 11. 11 for the issue. There was another issue of share. Can we go to note number 7 actually? Trade payable will be taken over by new company and immediately settled by issue of fully paid ordinary. Actually, creditors hatukuwalipa na cash. Tuliwapea nini? Payables. An amount of 870? 876. Itakuwa imebakia ngapi? 260? Aya. Now let's go to note number 10 again. Trigger Limited issued for cash all the remaining shares. So we issued additional ordinary share in cash. That means we raised an amount of how much? 260? Yeah, 264. Niweke tu hapa. Ordinary shares in cash, an amount of 264. Let's go to preference shares. Still at note number 1. Trigger Limited was formed with an authorized share capital comprising 600 million ordinary share of shillings 10 each and 40 million 6% preference share each at 100. So preference share we had 40 each at 100. So how much is that? 4,000. Now can we go back to note number 10? Trigger Limited issued for cash or at par value all the remaining ordinary share and preference shares not issued. Of the preference share, upon acquisition, this is what we issued. Preference shares issued, an amount of 20. So the balance was issued in cash. How much is that? 18? 1912. Now give me the cash balance. Simlisema mnataka kuonyeshwa eh? Ndio namuonyesha sasa. 41. So cash at bank, we have it 4103 point. Now give me goodwill. How do you get goodwill? Purchase consideration minus net asset account. So you can compute that. Once you compute it, take a screenshot. Or I show you how to get that. So first of all, take a screenshot. You see now you have made me to waste 10 minutes showing how to get cash. And if I tell you to do what I have done, you people to do what I have done. And imagine I've wasted my 10 minutes explaining. Now, when computing goodwill, this is how you compute the goodwill. You take the purchase consideration, 6348, then you take the assets taken over. And these are the assets taken over. So you are given how they were taken over. You take that, you add 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 that. Then cash at bank, it will take at book value, which was an amount of 271.2, so that you get the total assets taken over. Then you raise liability. Liability, you only had two liabilities. Trade payable and debit, because they were settled by the new company. That's how you get the net asset. So the difference between that and this, that's how you get the goodwill. You can try another question. Or you are tired? Good. November 2016, question 3. November 2016, question 3. At least we do one on internal reconstruction. Now, between the external and internal, which one is harder? External. Let me see. Part A of the question, we are told that explain 4 differences between the internal reconstruction and external reconstruction. That internal reconstruction, there's no liquidation. External, there is liquidation. Another difference is that internal reconstruction, there is no formation of a new company. External, there is formation of a new company. Internal reconstruction, there is no transfer of asset. In external reconstruction, there is transfer of asset. Internal reconstruction requires court confirmation. You cannot reduce the share until you have the court confirmation. But for external reconstruction, you don't need court confirmation. ETC. That's how simple they are. Number B. I think you have everything in your notes. I remember stating that one in class. The following is a summarized statement of financial position of P Limited as at 30th of June 2016. So you have all that. The court approved a scheme of reorganization. So up to that, is it internal or external? For those who are listening for the differences. That one is internal. So that in internal reconstruction require court confirmation. Yeah, you did that one in company law. That you cannot reduce the shares below the par. You can issue them at a discount, but it cannot go below the par value. But whenever you have the internal reconstruction, they will be written down below the par value. So therefore, you need a court approval. So the court approved a scheme of reorganization submitted by the debenture holders and agreed upon by the other interested parties to take effect on 1st of July 2016. Details of the approved scheme are as follows. Now, let's start here. When accounting for internal reconstruction, what are the major accounts prepared? Capital reduction account. Ordinary shares. Wengine waniangalia ni kama wanasikia it for the first time. Are you doing an exam in 1 week time? What do you write in an exam? We say that the major account is the capital reduction account. And since we are reducing the capital, and then there is, how do you prepare the capital reduction account? You say that you credit what the debt holder and the equity holder, they are doing what? They are sacrificing, right, together. Then you debit what is to be sacrificed. Now, see, this is what they are sacrificing. They are sacrificing to do what? To write off something. Now, what's to write off? What's making them to sacrifice? What you do what? You will debit, right, together. Such as accumulated. You see, they are sacrificing to write off the net liability, which has accumulated losses, goodwill eaten off, any expenditure to be incurred, right, together. Yes. Then another major account prepared is ordinary. Yeah, you need to adjust this. So now let's do number 1. The 6% debenture holder were to have their interest paid in cash and to take over part of the freehold property. Book value is how much? 160 at a valuation of 192 at part repayment of their holding. So the debenture holders, those are the debt holders, they have agreed that they take some freehold property. The book value is how much? 160 at a valuation of 190. So that means there is a revaluation gain of how much? That too. We see that you credit all the revaluation gains. So there is gain on transfer of property. The valuation is 192, but the book value is how much? 1. So that gain will be utilized in capital reduction. An amount of that is? The 6% debenture holder are also to provide additional cash of 28 million secured by floating charge on the company asset at an interest rate of 12% per. So let me open for you the cash account. Can I go to the trial balance? Do we have any cash or bank holding? What do we have? We have nothing, right? Good. But we issued debentures. What does it mean? Can we read the last sentence? The 6% debenture holder are also to provide additional. In short, we issued a debenture worth 208, secured by a floating charge. So we issued a debenture worth how much? If you issue a debenture, that means your cash will increase. Number 2, patent and goodwill are to be written off. So the assets to be written off, we see that all revaluation losses, you do what? You debit. Yes, and the first item we are sacrificing is right off the accumulated losses. So first of all, let's start with the accumulated losses. How much was the accumulated losses? We have an amount of 650. Then you are told that patent and goodwill are to be written off. So you write off the patent as well as the goodwill. How much is the value of the patent? 244, and goodwill, you have an amount of 224. Also, I told that the patent and goodwill are to be written off. 120 million is to be written off inventory, and 93.6 million to be provided for bad debt. So you have inventory written off. They wrote off an amount of 120. Also, receivables, they provided for provision for bad debt. So we had the bad debt. In short, that's reduction receivable, an amount of 93.6. Yeah, that's reduction receivable. It's a reduction in an asset. Then you are told that the remaining freehold property is to be revalued at 620. So is that a revaluation gain or loss? Can you compute? Give me the specific amount. It can either be gain, can be loss. Me, what I need is the amount. That's what we'll mark. So can you give me your wrong answers? Or you can prove me wrong, by give me a correct one. Yes, I need your wrong answers. Your wrong answer is 60. Your wrong answer is 60. Paris, your wrong answer is 100. Paris, 60. 60. Torman, your wrong answer is 0. Mwagagi, your wrong answer is 60. Aya. Now let's see. Is it again or loss? A loss. A loss or again? Loss, Yeah, so I told you you'll be having a wrong answer. So we have a revaluation gain. Yes. Now, we are told that the remaining freehold property is to be revalued at how much? 620. Are we there? So you compare the revalued amount against the net book value. Now let's go to the trial balance. How much was the freehold property? 680. First of all, you minus the one the debenture holder took. They took at? So minus 160. 680 minus 160? 580. 520. Then that's the remaining assets. Then you're told that at the end it was revalued at 6. Again, of how much? Revaluation gain over 100. That's why you're failing with your wrong answers. Then you are told that number 2, the last sentence, the investment was sold at prevailing market value. Be sold at again or loss? Give me a correct answer now. How much? Oyugi? 130? Are they getting 136? Or they're getting 0? We have a disposal gain, and you are told that the investment was sold at prevailing market value. Let's go to the current assets. Investment, the market value is 220. How much is the carrying amount? So there is a gain of how much? How much are you getting? 136. That's a gain. Number 3. The directors, so let's be here. Cash, we have sold what? What have we sold? Good. Tumeuza pesa ngapi? Yeah, you see, we are told that the investment was sold. If we sold, what will happen to a cash account? It will increase. Good. The director were to accept settlement of their own of as 90% thereof by allotment of ordinary share at par and 5% in cash. The balance of 5% is to be? So how much was the director's loan? It's an amount of 160. So let's go to ordinary share capital. Give me the balance breakdown. Ordinary share capital, you had an amount of 1,200. Then director's loan, it's an amount of 160. And we are told that director are to accept settlement of their own as to 90% thereof by allotment of ordinary share. So 90% we give them shares. Minus 16, you get 140, 144. 5% through what? Cash. So will it affect our cash account? Good. Director's loan, 5% of 160, you get 8. And then what about the other balance? It's to be waived. Will it affect our accounts? Yes. We see that you are creating what the shareholders and the debt holder they are sacrificing. They have sacrificed 5%. Good. Director's loan. They have said that they give up on 5% of 160, which is 8. Good. Number 4. Trade payable were to be paid 0.1 shilling for every shilling to maintain and obtain an extension on the credit period. We paid them, right? So it will affect our cash. So payables. How much do we pay them? Not 0.1. I want the full amount. It's an amount of 40. Yeah, it's 0.1 times 400. You get an amount of? There is a balance of how much? 400 minus 40 is 360, right? Where do you take 360? Will it affect our capital reduction account? You see, you have paid them 10%. 0.1 of everything, that's 10%. Ama, what about the other 90%? Will it affect our capital reduction? No. You see, they have not waived. Are you together? Sini kama uko na deni ya mtu mlipe kidogo akwambia ni sawa tu utalipa baadaye. Does not mean has forgive. Have you told that they forgone the balance? No. So it will not affect the capital reduction. Now that's what now will go to the balance sheet. Are you together? So to the balance sheet, the trade payable will be 400 minus 40, which is 360. They never waived the balance. They only accepted you pay them 10%. Number 5, the bank has sanctioned an overdraft limit of 10 million to provide working capital. Number 6, the 6% preference dividends were 4 years in arrears, of which 3/4 are to be waived, and ordinary shares are to be allocated at par for the dividend in arrears. So we have to pay them. So you have to sacrifice to pay them. So dividends, that's what we call unrecorded liability. Dividend in arrears. How much is that? So you take 6%. How much was the preference capital? 640. There were how many years in arrears? Is it 4 or 3? So how much was the dividend in arrears? 153 point. Then we are told that the preference dividend were 4 years in arrears, of which 3/4 are to be. So they have sacrificed. So will it affect the capital reduction account? Yes, they have waived. So a dividend in arrears, 153.6, 3/4. I'm gonna give up. Gapi? 150.2. 115 point. There is a balance. 153.6 minus 115.2. How much is the balance? Good. What about the balance? We are told that they were to sacrifice 3/4, and ordinary share to be allocated at par for the balance. So for the balance, we issue new shares. So here we have dividend in arrears. So you say that it's 153.6 minus 115 point, or you can do this 115.6, you multiply by, they sacrifice 3/4. So the other quarter they are to get what? It was an amount of 38.4. Number 7. You see that internal reconstruction is much easier than external reconstruction. Number 6, the 6% preference share are to be written down to good preference share capital. How many preference shares we have? Let's go to the top balance. That's 64. 64. Are you there? Then you multiply by, you are told that number 7. The 6% preference share are to be written down to 7.5. How much is the par value? 10. To be written down to 7.5. So that means there is a loss per share of how much? Yeah, they sacrificed 2.5 per share and they had 64. So they sacrificed a total of how much? Yes? 160. Good. And the existing ordinary shares to 2 each. Also ordinary shareholders, ordinary share capital. How many ordinary shares do we have? 120. Then you are told that. Let's read number 7 again. The 6% preference share are to be written down to 7.5 and the existing ordinary share to 2. How much was the par value? 10. 10 to 2. There is a loss of how much per share? 8. They sacrificed 8. How much is that? Sorry? 9? 60. Then what they sacrificed, it reduced the value of the capital. This is what we had. Then there was capital reduction. And they sacrificed an amount of 960. Good. Then you are told that all the ordinary shares are to be consolidated into shares of 10. The rate of dividend on preference share is to be increased to 10. That one will have no effect. Number 8. There are capital commitment amounting to 600 million, which are cancelled on payment of 3 and a third on contract price as a what? Penalty. So we'll pay a penalty. Nani atalipa? Ni kampuni. So they have to sacrifice that. So there'll be penalty. 3 and a third of 600. How much is that? It can't be 2,000. 3.3% of 600. You get 20, 20. Then we are paying. So therefore, will it affect our cash? Penalty, an amount of 20. Good. So I think we are through. Now let's go back to the equity. I think under the equity have adjusted everything. What else have we not adjusted before we close off the accounts? So now let's close off the accounts. Let's start with the capital reduction account. Which one? This one is 1511.2. What about this? Sorry? 23. So that means there is something we have not yet factored. What have we not yet factored? Yes? It's the same. Good. So it's how much? 1511 point. Good. This one balance. Okay. Capital. Are you getting that? Good. So how much now will be the balance carried down? 422 point. What about the cash? That's 4, that's 2. You get 360? Yeah, so that's our balance carried down. So I think with that, hey, no, there is something we have not adjusted. Can we go back to note number 1? The 6% debenture holders were to have their interest paid in cash. We have not yet paid what? The debenture interest. The debenture interest was to be paid in cash. So how much is the debenture interest? Is it 36? Then I asked whether we had bank OD, and we had. Mnaiona? Yes. So you had bank OD, which will affect our cash. Lakini mlisema haukuiona. Ilikuwa ngapi? 312. So give me now the balance carried down. You get? 16. Good. Required. Number 1, the capital reduction account to record the scheme of capital reduction. 8 marks. Have we done that? Yes. Number 2, statement of financial position of P. P Limited. Statement of financial position as at 1st of July 2016. So our sharings are in millions. So start with the assets. Non-current assets. So the non-current assets, we have freehold property. How much is freehold property? You have an amount of 620. We have plant. Plant was not adjusted. It's an amount of 80. Then we have the current assets. And the current assets, we have inventory. An amount of 680. You minus 120. And you get 560. Then we also have receivables. Receivables is an amount of 776. You minus 93.6, and you get 682.4. Then we have cash, amount of 16. Give me the total assets. $19. Equity and liabilities. And equity and liabilities, we have ordinary share capital. And the ordinary share capital, we have an amount of 422.4. Then we have the preference share capital. Preference share capital. How many preference shares do we have? You take 64, you multiply by 7.5. How much is that? 480. Then did we have, yes, then we have non-current liability. Non-current liabilities, we have 6% debentures. And 6% debenture was an amount of 600 minus. Number 1, the debenture holder were to have their interest paid in cash and to take part of the freehold property. Book value of 60 at a valuation of 190. You minus 192. How much is the balance? 4. Then also you're told that the 6% debenture holder are also to provide additional cash of 208 million secured by a floating charge on the company asset at an interest rate of 12. So we have 12% debenture. An additional 208. Let's go to the current liabilities. Current liability, we have account payables, an amount of 360. It's 400 minus what? 40. Bank OD has been paid, debenture interest has been paid. Also, we have what? Accruals, an amount of 80. Director's loan, what happened? they were paid. Try to balance that. Sorry? 19? Good. 19.4. Good. You can take a screenshot. So next class we'll discuss, what do you want us to discuss? Cash flows, eh? Good.